After that tease, we got to call the show the Handsome Report. It is not just technology. It's not just technology in focus today. It's a rare positive call in the deep water oil space out there as well. When's the last time we said that? Wells Fargo upgrading Transocean offshore, ticker RIG, to outperform, saying there's upside ahead, in part because of increased demand as well as our higher expectations for what Transocean can rent its rig for. It's known as the day rate in industry parlance. Shares are about 15% higher over the past month. It is your call of the day. We've talked a lot about oil in the last couple of years. Yeah. Deep water has been...
You've been all over it.
Well, thank you. Yeah. Deep water has been forgotten. The costs are higher. Yeah. It's riskier, lower success rate. What do you make of this?
It's about leverage, and it's about where oil is, right? I mean, you know more better than anybody.
Well, these rigs are $1 billion, by the way.
But as
hugely capital intensive. What do you make of this?
And as we push towards 70, those numbers actually start to get a little bit more comfortable for folks, and obviously the leverage starts to kick in.
If we stay around 70, the cash flow gets better.
And we've gotten a little bit closer to hanging near there. Now, we've sold off a little bit for a while. We got into mid-60s once again, and then you push back towards 70, Sully. But I still think, I like the name. Do I love this upgrade? I think it's okay. I think they should do well if oil continues. But we talked about if oil grinds, where would you most want to be? We had activity just last week, unusual activity in the XLE. It went from 74, now it's 75.40. So what do I like best right now? I like ExxonMobil. I like Chevron. I like some of the bigger names because I think with what they've got in terms of their balance sheets, they are positioned very, very well for this. But
this is not a supply-demand call for oil. It's a supply-demand call for the number of rigs. And what Wells Fargo has said here is that Tier 1 and Tier 2 rigs, the best rigs and the best leases, have an 80% utilization rate. Mm-hmm. So do you even have to like oil, I wonder, John, or is it literally a play on, I need to rent a car, there's not a lot of cars left, prices are going to go up? That's effectively what they're saying here.
That's exactly right. It's supply and demand. And for the best stuff, the best rigs, as you're saying, but the CEO said it September 4th, Brian, when he talked about what they're doing over at Transocean, and that they were seeing an acceleration of these day rates and everything moving up. Wells Fargo's identifying that as well today, so credit them for it. But I got to believe that prices are going up with this at 70 plus.
I think this is also an underinvestment story, right? For the last number of years, we've underinvested not only in the U.S., but especially globally. So, and you're right, in a 70-plus crude oil environment, it actually does start to make sense to drill not just in the U.S. shale,
you
but elsewhere.
You mean your clients have been underinvested, or the industry has underinvested in this?
The industry has underinvested in future oil exploration. I mean, of course, in the Permian Basin, we're seeing tremendous growth, but we have underinvested in deep water. Saudi Arabia had to pull back. Russia had to pull back. So because of that, there is actually longer-term need to boost some of this output and production.
I mean, I do think this is a call on oil, though. I think if oil can stay, as you guys said, that's why you want to own the stock. But if oil goes back to the 50s, stocks like this get punished a lot
They'll be the first
quicker,
one sold,
right?
Because their capital costs are so much
all of a sudden,
higher.
and if you get a credit market issue, these are the stocks that get hurt. So this is a high beta play. Could have great upside, but I think there's more opportunity elsewhere.
Just like on land, they've gotten smarter about costs. Everybody has brought their costs down 30 to 50% over the last 5 years in every form or fashion because they have to.
Whenever you're down there in Houston, Brian, and you're talking to these guys, because I watch when you're down there, the thing is that it's a boom or bust cycle. And presently, we're on the upswing for them. That's what Wells Fargo's talking about here. And I think that plays out if there is a break, either credit, like you say, or a break in crude and it heads towards 50.
Fair enough. And I've been critical on oil as well because the cure for higher prices is higher prices. Oil at 100 will lead to oil to 30 because everybody overinvests and then we have too much supply and prices crash. But $70, isn't that kind of the sweet spot? And if there is one, gas prices aren't too high, consumers not ticked off. You're making a little money on oil.
It really is, and it's really a sweet spot, I would say, for some of the shale producers in the Permian, right? $55 a barrel is roughly what you look at for break-evens. And, you know, as we always talk about this, selecting the individual spots and stocks, you want to select the stocks within the Permian that are not exposed to this Midland differential, which you know has blown out quite a bit.
I guess we should call it the light and sweet spot with oil.